Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsati, and in this week's podcast, we are going to talk about why the next 3 months, which is January to March 2023, which is the last quarter of a fiscal year and the first quarter of a calendar year, is going to be very tricky for bond markets. Now, we have already seen the bond yields starting to rise. The 10-year yields have closed this week at its highest level in over a month. And there is clearly a lot of nervousness in the market at this point of time. Though the yields have been holding steady after climbing to 7.5% in the last 6 months, but they have been holding steady at around 720 to 730, 735 levels. Now they're climbing, and there is a lot of fear, and this fear is emanating from many factors. One is that the budget is coming up in February, and clearly the government now looking to keep the economy growing. The spending is still going to be high, and with the spending still high, then borrowing is also going to be heavy. So another 1 year of heavy borrowing for the markets, and with government and state government borrowing well close to rupees 20 lakh crores. That's a very high level of borrowing. The markets have been absorbing the borrowing. This year has been pretty much smoother. And well, the reason is because the yields of RBI has allowed the yields to move up. And if investors recall, in the last 2021, 21, 22, especially when RBI, the market was reluctant to absorb the heavy government borrowing at 10-year yields at around 6%, 6.1%, those kinds of yields, or even below. But RBI was keen on keeping yields down, and hence there was a lot of issues surrounding auctions, including cancellations. RBI giving it, get devolving to primary dealers, and etc. But once they have allowed the yields to move up, then the markets have been on their own taking up the borrowing now, which clearly tells you that central banks are better off not intervening in the market. Now we are seeing this phenomenon happen globally. It's one of the most disastrous consequences of central bank intervention in government bond markets. When U.S. Federal Reserve kept buying bonds at levels of 1.1 to 1.5%, and then your ECB kept yields at below 0%. Even Bank of Japan had an indication of 0% levels on the 10-year. And now all these have moved up very sharply, and investors who have followed central banks have lost a huge amount of money. Prices have crashed. The Eurozone prices have crashed for almost by 40 to 50%, some even in the UK. US yields too, their prices too have crashed. So a huge amount of losses are sitting on investors' books. Even in India, it's the same case. And hence, now with a fresh borrowing coming up, and the RBI clearly now has seen the folly of its actions, and is keener to let the market decide the yields, because they don't want to send out wrong signals by supporting the market, and also making sure that that their stance is also being sent through to the market. And the policy stance is clearly moving from accommodative to tightening. In the last policy in December, RBI clearly said that policy is still accommodative given inflation and where the repo rate is. It needs to rise more. And when it needs to rise more, then clearly they are still in a tightening mode. And they're happy to let the yields rise. And in globally too, the same thing is happening. Eurozone inflation came in at 9.2% in December, and much higher than, I mean, it is still lower than what it was in November, but still at very, very high levels in comparison to where the rates are in Eurozone. And it doesn't, and similar is to the Fed. So clearly a long way to go for the markets to adjust. And the next 3 months, if the market is to look at staring at a heavy borrowing starting April, then clearly they would need to start taking up yields now itself so that the yields can they're not very uncomfortable absorbing market borrowing at higher levels of at lower levels of yields. Also, with the rupee still hovering at record close to record lows of rupees 83 to the dollar, and the current account deficit coming in at 9-year highs, still a lot of issue, still a lot of macro data points that are negative for bond yields, and all that will prey into the investors' minds as well. And the last quarter of the fiscal year is also where liquidity is pretty much tight, and corporates tend to shore up on liquidity. And with the market now, yeah, still seeing short-term rates higher, and liquidity getting tighter so for corporates, then clearly they would need to access the bond markets for uh, funds, and they would be willing to pay whatever level the market is giving them, which would be higher levels. So investors, the next 3 months are going to be tricky. Investors can find opportunities when there are short-term papers available at high levels of yields, and those are the opportunities that investors need to grasp rather than trying to take a longer-term view in the markets at this point of time. So stay short and stay safe and get that extra returns when opportunity comes across. Thank you very much for listening in. And follow us on all podcast channels of Spotify, YouTube, and Apple Podcast. Uh, all the and Do send us any comments that you require that you want on the podcast, any queries, any discussion points you want to engage with. We're happy to oblige. And if you're a financial advisor, obviously the best place for you is INR Bonds Partner Portal. See the best bonds available in the for your investors given market environment, and invest in the best bonds with the most risk adjusted return that suits your clients' portfolios and requirements, and with the full INR bonds experience of the full support that we give you from pre-transaction to transaction and post-transaction, and obviously along with the best in-class information and all data that you require to take the best investment decisions for your clients. Log into Partner Portal and see your assets grow in fixed income. And download our app, Quick Invest Buy in our bonds for a curated list of bonds over a universe of 300, 400, close to 400 bonds that is live on our platform every day. And this curation is done so that investors can have a easy way to select bonds for investments and with their own proprietary risk score to get the best risk adjusted return for their investments. Thank you very much.